Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Back with us at the Market Site Times Square, we have Bob Yawger. He's a senior energy analyst over at Mizuho Americas. We're going to take a look at what's moving the energy markets, and like any other market, it's the trade deal that is impacting prices. Bob, it's great to have you back with us as always. And in addition to OPEC and the IPO, trade deal seems to be weighing on every market, every conversation that you're having. And oil market's no different.
No different. Maybe even more so, because it is the demand indicator, basically. So any kind of demand that we could generate from the trade deal will put a bid in the market. Any day that you come in and there's a negative vibe, the market tends to pull back a little bit. Any day that it looks good, you start to trade higher. We have been trampling on the 200-day moving average for 11 days in a row now. We did put in a 8-week high last night, but it seemed that sentiment seemed to sour on the trade deal as the day developed here, and we have since pulled back below the 200-day moving average. 11 days in a row, the market has traded on the 200-day moving average. We were looking like we were going to clear it today, pulled back and traded on top of the 200-day.
Now, does supply remain an issue? It seems as if that's really where the overhang is until you can get rid of the supply constraints. Why would it go any higher?
Yes, it's a huge supply overhang, too. We posted up a brand new 12.8 million barrel domestic production number on Wednesday, and we had a storage build also. But because of the trade deal and the sense of optimism that surrounded it in the following hours and then the next day, we still managed to trade north of that pretty good. Still anchored at the 200-day, of course, but we did clear some of the previous highs that we put in a couple of days, and we posted a new high on Friday, and we eclipsed that today, only to pull back down 1% as I walk in the door here.
Yeah, well, it's Monday, November 18th, for those of you that are catching it on the go-around here. And as soon as those headlines came out, I believe a government official told CNBC that they're not quite as positive about the trade deal as we might think they are. And clearly it's being reflected in prices. But there's also the OPEC December meeting that is certainly going to have, whether for the good or bad in terms of the price target, how it's going to move it. What will you be looking for out of the meeting?
OPEC folks really need to cut production again. They've already cut 1.2 million from their production. They've been riding on that number for quite some time, with a pretty good level of compliance for that matter too. Of course, the Saudis and other Gulf states, they bear the brunt of those cuts. You get significant cheating out of Nigeria and Iraq, but the two countries that have been beat up over the years, and their argument to a certain degree is that they've underproduced for a while, and now they're getting back to where they need to be. But they need to cut barrels. They've implied that they're not going to do that. So we'll have been trading in this 56 to 57.5 area for 2 or 3 weeks here. If we get to December 2nd, we're still hanging out in that same area, and they don't do anything, we could come undone rather quickly, in my opinion. The problem is demand growth next year is going to be eclipsed by far by additional barrels coming online by non-OPEC sources. And from non-traditional sources like Guyana, for example, ExxonMobil, huge project that will get underway in 2020. And those big numbers are just going to swamp demand, global demand growth, and they need to cut. They need to cut supply.
Yeah, I mean, it sounds with that prognosis in place that getting north of 60 does not seem reasonable if more supply comes onto the market.
No, it's really not. I would say this, though. If you came out with a signed deal, a trade deal tomorrow, it would maybe be worth owning something like $60 calls. I wouldn't go much higher than that, and I wouldn't expect it to go very far above and beyond that. But there is a possibility, if you can buy them relatively cheap, that it could get there. That said and done, it wouldn't be long. And the reality would be a slap in the face rather quickly that supply is just too much.
And this might sound like a rookie question, but even if you get a trade deal, that has nothing to do with supply, unless I'm missing something. So
It's the demand side of the equation. Also, energy has really correlated to equity markets here real quick. I mean, you could say it's a chicken or the egg, whether it's a trade deal or equity markets. They're both, first you get news trade headlines, then you get the equity rally. Is crude oil correlating to the news, or is it correlating to the equities? One or the other, but they're both come off as demand indicators.
Right, and I'm sure oil's certainly going to be watching what comes out of the IPO. That's certainly going to make headlines.
Yes, it's going to be a big event. It's going to be the largest of all time. It'll probably generate the most income of all time for Aramco. It'll probably tie Alibaba at something around $25 billion. But yes, scaled back the plans a little bit, it looks like in the press, but it's going to be a whopper. And it coincides perfectly with the OPEC meeting too, basically. So yeah, it's going to be a really interesting development.
All right, and to wrap up here, how are the equities reacting? Are the refiners performing well, or is it midstream, upstream? They certainly have to have a little bit of impact on the stock price due to what's happening with underlying.
Yes, it does. In the last couple months here, refiners have been doing very well. Phillips 66 in particular has been doing quite well. Valero has been doing well. And those two, and the other, HFC and Marathon even, they've been doing well this year. They're in the green. Hess is the best performing name in the XLE space. However, last week, the S&P 500 energy names, they pulled back. They were in negative territory despite the fact that heating oil, crude oil, and gasoline, the three elements of the barrel, were all, the commodity, all three elements were in positive territory last week. But S&P 500 energy names were in negative territory. So there's a disconnect last week, which is rather odd. Midstream last week, you take some of the midstream ETFs, or indexes, and they were traded down to dangerously low levels, that they're approaching multi-year low levels. So that's a bit dangerous, but refiners look good. A few of the E&P names look really good. It's a matter of geography, but some of them could do well too. Like Hess, for example, association with the Guyana project, that's really putting a good bid for them.
All right, Bob, great to see you as always. Thanks so much for joining us.
Thank you.
And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.